Hi guys, Phil Rogers and Jesse Moore here from Low Market Edge.
How we doing?
This week with what's trending in lending.
Lots to unpack this week.
The B word, the budget, the week that was. What a moment. Look, probably two really big topics this week are around rate rises. We talk about what are we talking about the most with clients at the moment. One is around rate rises, and the other is the B word, the budget. And what does that mean for property? And I guess more importantly in this chat is what does that mean for you? So let's jump in. 3 rate rises since January.
Undoes everything that we did last year. Puts us back to square one.
0.75. One of the things we're probably talking a lot to clients this week about is what does that mean for you? What do those numbers mean? So on an 800,000 mortgage, each 0.25% is about 120 a month.
Give or take, yeah.
You're roughly $375 a month more what you're paying on your mortgage than you were 5 months ago.
It's a lot, and especially when we're looking at these things like that's a lot of money.
Well, we didn't have that money before those movements, right? So I don't know where that's come, right? And more tax.
Yeah.
And I guess the question there is we've talked about like who's feeling that the most, do you think?
Definitely variable rate holders. I think it's probably most crucially, you ride that wave. It's great when it's going the other direction, and it's a wave that you kind of committed to riding. So I would say that most of the calls that we're having, people that we're speaking to, the variable rate holders are probably the focus. Yeah. And I guess anyone coming off those fixed rates that may be locked in for 5 years and sort of 21, 22, rates were still
last of the unicorn rates.
That's it. So really crucial time for anyone exiting fixed rates that maybe got in at that time. But those are probably the two primary,
And I think off the back of that as well, when we were interested in talking this morning, is that there's a lot of people calling up asking, should we fix? What does that look like? And it's such a not a guessing game, but it's so important to have a conversation around the why, because case by case it's going to be really different.
Yeah, it's the most individual conversation we probably have, outside of the general goals and objectives of what you're doing is should we fix? Well, it's
fix
not,
a variable.
It's not a black and white question, right?
Especially at the moment. Now let's talk about the B word.
The budget.
The budget, the big bad budget. Look, it's obviously hitting a number of areas, but 2 areas I thought today would be really good to probably touch on is one around investors. Big changes in a couple of areas. One is around negative gearing on existing properties as of July 2027. So that is gone. That will have some huge impacts.
Absolutely.
Still remains for new builds going forward though.
Yes.
Which again, a little bit of a pivot maybe for where some of that stock may go.
Yep, absolutely. Definitely still a lot of opportunity. I think that key thing when we were talking this morning was it's a pivot, it's a shift, but it doesn't necessarily change how we approach things. And I think that's probably the most crucial part is that there's still opportunity, it is just different opportunity, and it's just reshaping what those goals, what those objectives are, what the next 5, 10, 15, 20 years looks like to be able to just making the right decisions now.
It's a lot more advisory, I think, with what we do these days versus, we always were relationship based and not transactional. But I think even that next kind of level that we've taken it to as a business is around that advisory piece and really setting those goals and objectives and that customer for life approach.
Yeah, absolutely. I think important to note as well with all that negative gearing stuff, as we talked about just then, the 2027 July 1 date, really important to know that they are grandfathering that in. So for any contracts exchanged prior to 7:30 p.m. on the 12th when they announced it, you are subject to the previous rules up until that date. So whether or not that's settled, obviously all that sort of stuff, it is based on the contract date. So anything signed, anything exchanged prior, you are subject to that previous rule.
And I mean, effective immediately isn't a nice feeling, but it is nice that it is associated or attached to that contract date, not a settlement date. Absolutely. So that's a big one to remember. And then buyers, a huge buyers, but first home buyers in particular. Be it there was a lot of their words intended, I feel maybe unintended consequences or challenges that have come out of this. There are still some positives, like you said with the investors, a little bit of a pivot. First home buyers in particular, I know it's tough and I know there'll be a lot of changes, but there are some wins in there.
Yeah, for sure.
And I think it's really important to note what we're kind of seeing around that pace. And I think you will find that when the banks have been so exposed to the investor lending, especially we talk about the big 4, one of them in particular, just by sheer scale, has such a large portion of their business written through investor, that pivot for them becomes really obvious, right? And that is a move into that first home buyer space. And I think, a few of the things, and we've watched this trend over the years as these things get released, and because the market will always be the market, the government unfortunately will always be the government, there's always going to be these things that will come into, and it's how the different markets react. And the banks in particular, we found things like cashbacks, fee waivers, policy kind of exceptions or exemptions. They kind of get really aggressive in that space, because if you find that a big portion of your business is written by investors lending, which they found, which now isn't, and they're going to pivot and they're going to have to target another area of the market, the real winner there hopefully will be first home buyers.
Well, they're going to have to do something different than what they've previously done, because obviously with all the other changes on this side, if everything stays the same in this lane, well, then they're just wearing the loss. They're not going to pivot appropriately. So there will have to be that balance and flexibility.
Would love to see them fighting over that business.
100%.
Right? With again, the real winners out there being first home buyers. And I don't think it will align to, not straight away anyway, lower interest rates. What we'll see first is the moves in that space. Again, cashbacks, fee waivers, policy exceptions for first timers, all of that will start to loosen to get them in the door. And then maybe over the next 6 to 12 months, we might see some interest rate drops.
Be nice.
Yeah, wouldn't it what? But look, they're probably the two big ones we're talking about this week. Our encouragement is that if there is a curiosity, if there is a question, if there is a, what does that mean for me? Pop up, just jump on the phone, give us a call. We're working through this, interpreting a little bit of it as you are maybe at the moment. 100%. We've got some great accountants and financial advisors on our side that are really helping us work through this as well. So very particular to your circumstances, let's jump on and have that chat. Talk to us rather than ChatGPT, and at least try and get a little bit more personalised advice. So
I've certainly had a couple this week come across the desk that, hey, I've ChatGPT'd, is this the true? And unpacking the finer nuances of your situation definitely helps to pivot the strategy.
Yeah, great. Reach out to myself, Jesse, Vanessa. We're here to help, and we'll see you guys next week. Bye for now.
Thanks, guys.